My dear students, welcome back to our channel. In this video, I will be explaining the Bachelor of Commerce 6th semester subject theory and practice of GST as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3. The first important short question is: 1. What are exports under GST? Exports mean sending goods or services from India to another country. When an Indian seller sells products or services to a foreign buyer, it is called an export. Under GST, exports are treated as zero-rated supplies, which means the GST rate is 0%. But this does not mean the seller won't get any tax benefits. The exporter can claim refund of GST paid on purchases, input tax credit. Export without paying GST by submitting a bond or letter of undertaking, LUT. Example: Ravi from Mumbai exports cotton shirts worth 1 lakh rupee to a buyer in the USA. He can either export without paying GST by using LUT or pay GST and later claim a refund. Easy tip to remember: exports is equal to GST 0% plus refund benefit. Goods go outside India, GST benefit stays with you. Next important short question is: 2. What is cess sales under GST? Cess sales means selling goods or services to a special economic zone, cess, unit or developer. Cess are special areas in India where businesses get tax benefits to promote exports. Under GST, any supply made to an cess is treated as a zero-rated supply, just like exports. This means the seller can sell without charging GST by submitting a letter of undertaking LUT, or can charge GST and later claim a refund. Example: Akash Electronics in Bengaluru sells computers worth 2 lakhs rupee to a company in a nearby cess. Akash can avoid charging GST by using LUT, or he can charge GST and claim it back. Easy tip to remember: cess is equal to 0, GST is equal to tax-free zone. Cess buyers don't pay GST, and sellers can claim refunds. Next important short question is: 3. What is mixed supply of goods under GST? Mixed supply means selling two or more goods or services together in one package, but each item can be sold separately, and they are not naturally bundled. Under GST, the highest GST rate among the items is applied to the entire package. Example: imagine a gift box that includes chocolate, GST 12%, a soft drink, GST 18%, a small toy, GST 28%. This gift box is a mixed supply because all these items are unrelated but sold together. GST will be charged at 28%, highest rate, on the entire value of the gift box. Easy tip to remember: mixed is equal to mix of unrelated items is equal to highest GST rate applies. Not naturally sold together? Then it's mixed supply. Next important short question. 4. What is Challan reconciliation under GST? Challan reconciliation means matching the GST payment details made through challans, like taxes paid via GST portal, with the records in your books or returns. Whenever you pay GST, CGST, SGST, IGST, a Challan, form GST PMT 06, is generated. These challans help keep track of how much tax you have paid. Why is it important? To make sure no extra or less tax is paid. Helps in filing accurate GST returns. ensures GST payments match with GSTR, 3B and cash ledger. Example. Ravi's company paid 50,000 rupees GST in April using a challan. But in books, the entry shows 45,000 rupees. During challan reconciliation, he finds a 5,000 rupee mismatch and corrects it before filing the return. Easy tip to remember. Reconcile is equal to match your tax challenge with records. No mismatch is equal to no penalty or confusion. Next important short question is 5. What are imports under GST? Imports mean bringing goods or services from another country into India. When an Indian person or business buys something from outside India, it is called an import. Under GST, import of goods is treated as interstate supply, and IGST, integrated GST, is charged. This tax is paid at the time of customs clearance. Example. Rohan from Delhi buys a laptop from the USA worth 50,000 rupees. At the time of arrival in India, IGST is charged, say 18%, is equal to 9,000 rupees. So, total cost is equal to 59,000 rupees, 50,000 rupees plus 9,000 rupees IGST. The IGST paid can be claimed as input tax credit, ITC, if Rohan is a registered GST dealer. Easy tip to remember. Import is equal to goods coming into India is equal to IGST applies. Tax paid at customs is equal to can be claimed later as ITC. Next important short question is 6. What are exempted goods under GST? Exempted goods are those goods on which no GST is charged. These goods are free from GST, even though they are sold or bought in the market. The government decides and updates the list of exempted goods to help common people and promote essential items. Examples of exempted goods: fresh fruits and vegetables, milk and curd, bread, salt, books except e-books. Important points. No GST is applied on exempted goods. The seller cannot claim input tax credit, ITC, on purchases related to exempted goods. Exempted goods are different from zero-rated goods, like exports. Easy tip to remember. Exempted is equal to no GST plus no ITC. Basic or essential goods is equal to exempted under GST. Next important short question is 7. What is input tax credit set off under GST? Input tax credit, ITC, means you can reduce the tax you pay on your sales by the tax you already paid on your purchases. Set off means using your ITC to pay GST. Example. Suppose you buy goods worth 1 lakh rupees and pay GST 18,000 rupees. Then you sell those goods for 1,50,000 rupees and charge GST 27,000 rupees. You can set off 18,000 rupees, input tax, from 27,000 rupees, output tax. So, you only pay 9,000 rupee to the government. GST set-off order. 1. IGST credit use for IGST, then CGST, then SGST. 2. CGST credit use for CGST, then IGST. 3. SGST credit use for SGST, then IGST. CGST and SGST cannot cross each other directly. Easy tip to remember. ITC is equal to pay less GST by adjusting input tax. Set off is equal to reduce tax burden smartly. Next unit 3 important long questions. First important long question is 1. Write about mixed and composite supply under GST. Mixed and composite supply under GST. Under GST, sometimes two or more goods services are sold together. To apply the correct tax rate, GST has two special terms. 1. Composite supply. Meaning, when two or more goods services are naturally bundled and sold together, and one is the main, principal, item, it's called composite supply. The GST rate of the principal item applies to the whole supply. Example. You buy an air ticket that includes meal service and baggage handling. The main item is equal to transport. Meals and baggage is equal to part of the service. So, transport is the principal supply, and GST is charged only on that. 2. Mixed supply. Meaning, when two or more goods services are sold together for a single price, but they are not naturally bundled, it is called mixed supply. The highest GST rate among the items is applied on the whole supply. Example. A shop sells a Diwali gift pack with chocolate, GST 12%, soft drinks, GST 18%, and a toy, GST 28%. These are not related items, just packed together. GST is charged at 28%, highest rate, on the entire gift pack. Easy way to remember. Type meaning GST rate based on example. Composite naturally bundled items principal supply flight plus meal. Mixed unrelated items sold together highest tax rate in the bundle gift pack with toys and sweets. Memory tip. Composite is equal to connected is equal to principal GST rate. Mixed is equal to mismatch is equal to highest GST rate. Next important long question is 2. Write about time limit and modes of payment of GST. Time limit and modes of payment of GST. Paying GST on time is very important to avoid penalties and stay compliant. Let's understand the time limit and ways to pay GST in a simple manner. Time limit to pay GST. GST has to be paid monthly or quarterly, depending on the type of taxpayer. 1. Regular taxpayers. File GSTR 3B, summary return, and pay GST by the 20th of every month. 2. Quarterly return filers, QRMP scheme. Pay GST monthly through PMT 06 Challan. File returns quarterly by the 22nd or 24th, based on the state. 3. Composition dealers. Pay GST quarterly by the 18th of the month after the quarter ends. File annual return, GSTR 4. Modes of GST payment. GST can be paid in these simple ways. 1. Online payment, net banking. Use your bank's online banking to pay directly on the GST portal. 2. Using credit debit cards or UPI. Some banks allow you to pay using cards or UPI from the GST portal. 3. Offline payment. Generate a challan, form GST PMT 06 and deposit cash or check in an authorized bank. 4. Using input tax credit ITC. If you already paid GST on purchases, you can adjust that amount ITC while paying GST on sales. Example. Ravi sells mobile phones. His total GST on sales for April is equal to 20,000 rupees. He has input GST credit of 5,000 rupees. He pays 15,000 rupees online and adjusts 5,000 rupees through ITC. Easy tip to remember. Pay by 20th or face penalty. Online, offline, or by ITC, choose your mode. Next important long question is 3. Discuss in detail about the accounting of GST transactions. Accounting of GST transactions. When a business buys or sells goods services, it must record GST properly in its books. Accounting for GST helps in correct filing of returns and avoiding penalties. Let's understand this in a simple and clear way. Types of GST. There are three main types of GST. 1. CGST, Central GST, collected by central government. 2. SGST, State GST, collected by state government. 3. IGST, Integrated GST, for interstate sales. Basic journal entries for GST transactions. 1. When goods are purchased within the state, intrastate. Example, goods purchased for 10,000 rupees plus CGST at 9% plus SGST at 9%. Total GST is equal to 1,800 rupees, 900 rupees CGST plus 900 rupees SGST. Journal entry. 2. When goods are sold within the state. Example, goods sold for 20,000 rupees plus CGST at 9% plus SGST at 9%. Total GST is equal to 3,600 rupees. Journal entry. 3. Payment of GST to government. When GST is paid, the input and output GST accounts are adjusted. Journal entry. Easy tip to remember. Input GST is equal to GST paid on purchases, asset. Output GST is equal to GST collected on sales, liability. Pay the difference to government. Proper GST accounting is equal to smooth GST returns plus no tension relieved face. Next important long question is 4. Define cess sales under GST and explain its types. Cess sales under GST, definition and types. What is cess? An cess, Special Economic Zone, is a designated area within a country that is treated as a separate customs territory. The purpose of an cess is to boost exports by providing businesses with special tax incentives and benefits. Cess sales under GST. When goods or services are sold to units or developers within an cess, it's considered an cess sale under GST. This is a special transaction because such sales are considered exports and therefore the transaction is exempt from GST. In simple terms, sales made to cess units are treated as exports and they enjoy benefits like zero-rated tax. Types of cess sales under GST. There are mainly two types of cess sales under GST. 1. Sale to cess developer unit, export sale. When a seller sells goods or services to a business located in the cess, it is treated as an export transaction. For this sale, the supplier can claim a refund of the input tax credit, ITC, paid on the purchase of goods services. Example, a seller in Mumbai sells goods worth 1 lakh rupee to a company in an cess in Gujarat. The transaction is treated as export, and the seller doesn't need to charge GST. Journal entry for sale. 2. Zero-rated supplies to cess. Supplies made to an cess unit are zero-rated, meaning that no tax is charged on the sale. However, the supplier can claim a refund for the tax paid on input goods services. This makes it a tax-free sale from the supplier's perspective, but ensures that exporters can claim their rightful input tax credit, ITC. Key points to remember. Sales to cess is equal to export sale under GST. No GST charged on cess sales. Claim input tax credit refund for purchases related to cess sales. Example for better understanding. Case 1. Sale to cess unit. A trader in Delhi sells goods worth 50,000 rupee to an cess unit in Chennai. Since it's an export under GST, no GST is charged, but the trader can claim a refund on the input taxes already paid for purchasing the goods. Case 2. Services to cess unit. If a software company in Bangalore provides services to an cess unit in Hyderabad, the transaction will also be zero-rated under GST, and no tax will be charged on the sale. Why this matters? Cess sales are crucial to encourage exports. They allow businesses to grow and create jobs while taking advantage of tax exemptions. For exporters, the zero-rated tax ensures that they don't face a heavy tax burden while selling to cess. Next important long question is 5. Discuss the applicability of GST for advanced receipts and payments. Explain the procedure of accounting of advance receipts and sales invoice in the same month. Applicability of GST for advance receipts and payments. What are advance receipts and payments? In business, sometimes customers make advance payments for goods or services before they are delivered. These payments are called advance receipts. Similarly, businesses may pay in advance for products or services they will receive in the future, known as advance payments. Under the Goods and Services Tax (GST) system, GST is applicable on advance payments when the transaction involves the sale of goods or services, even if the goods services haven't been delivered yet. Applicability of GST on advance receipts. 1. Advance receipts on sale of goods services. GST is applicable on advance receipts, even if the goods services haven't been delivered yet. For example, if a customer pays 50,000 rupees as an advance for a product, the supplier has to charge GST on the advance payment received. The supplier needs to pay the GST on the advance to the government, even though the goods are delivered later. Example, a furniture company receives 20,000 rupees in advance for a sofa worth 1 lakh rupees. GST is charged on 20,000 rupees and the supplier has to pay the applicable GST to the government, even though the sofa will be delivered later. 2. Adjustment of GST on final invoice. When the goods services are delivered later, the supplier issues a final invoice and adjusts the GST paid earlier. The amount of GST paid earlier as advance is deducted from the final GST payable. Procedure of accounting for advance receipts and sales invoice in the same month. Let's break it down step by step. Step 1. Advance receipt accounting. When the business receives the advance payment, GST is payable on the advance. This is accounted for as follows. 1. Receive advance payment. Customer pays 20,000 rupees in advance for a product worth 1 lakh rupees. GST is charged on the 20,000 rupees, example, GST at 18%. Journal entry. To advance from customers, 20,000 rupees. GST, 20,000 rupees times 18% is equal to 3,600 rupees is the GST payable on the advance. The GST payable is recorded. Step 2. Sales invoice accounting. When the goods are delivered in the same month, the final invoice is raised and the balance payment is made. Final sale amount 1 lakh rupees. GST at 18%, 18,000 rupees. Journal entry for final sale. Step 3. Adjusting advance payment. The 20,000 rupee advance received earlier is adjusted in the final invoice. The customer will now pay the remaining balance of 80,000 rupee after adjusting the advance. Journal entry to adjust advance payment. Step 4. Paying GST on total invoice amount. The total GST payable is 18,000 rupees, calculated on 1 lakh rupees, but the 3,600 rupees GST on the advance payment is already paid. The remaining GST to be paid is 14,400 rupees. Journal entry for final GST payment. Key points to remember. GST is applicable on advance receipts. When the final goods services are delivered, the advance receipt is adjusted against the total invoice. GST paid on the advance is adjusted in the final invoice, and the balance GST is paid. Example in simple terms. Imagine you book a wedding photographer for 50,000 rupees, paying 20,000 rupees as advance. GST is charged on the 20,000 rupee advance. Later, when the photographer provides the services, they raise an invoice for the full amount of 50,000 rupees and adjust the advance paid earlier. By following this process, both the advance payment and final invoice are properly accounted for in the same month, ensuring compliance with GST laws. Next important long question is: 6. Define composition dealer. Explain recording of purchases made from composition dealer with an example. Composition dealer under GST. A composition dealer is a small taxpayer who opts for a simplified method of paying GST under the composition scheme. This scheme is designed to make the tax compliance process easier for small businesses with a turnover of up to 1.5 crore rupees, 75 lakh rupees for special category states. Instead of paying GST on the full value of sales, a composition dealer pays tax at a lower, fixed rate on their turnover. This scheme is ideal for businesses that primarily deal in goods and do not provide services, except certain services permitted under the scheme. However, composition dealers cannot charge GST on their sales, and they cannot claim input tax credit, ITC, on purchases made from other businesses. Key features of composition scheme. Eligibility: small businesses with annual turnover of up to 1.5 crore rupees, 75 lakh rupees for special states. Tax rates: 1% of turnover for manufacturers and traders. 5% for restaurant service providers. No ITC, composition dealers cannot claim input tax credit on their purchases. Restrictions: cannot supply goods outside India, cannot make interstate sales, and cannot deal in non-taxable goods. Recording of purchases from composition dealer. When a regular GST registered business buys goods from a composition dealer, the purchase invoice should be recorded without claiming input tax credit, ITC, because the composition dealer cannot issue GST invoices. However, the regular business may still record the transaction in their books of accounts, even though no GST is paid. Example: recording purchases from a composition dealer. Let's say ABC Traders, a registered GST business, purchases goods from a composition dealer, XYZ Retailers, for 50,000 rupees. The goods are subject to a 5% GST rate under the normal GST system, but since XYZ Retailers is a composition dealer, they are not charging GST on the purchase. Here's how ABC Traders should record the transaction. 1. Transaction amount, 50,000 rupees. 2. GST payable, XYZ Retailers does not charge any GST since they are under the composition scheme. Journal entry for purchase from composition dealer. Since ABC Traders cannot claim input tax credit, ITC, on purchases from a composition dealer, no GST-related entries need to be made for ITC. Key point: even though GST is not charged on the purchase, the business cannot claim any input tax credit. This makes the purchase price effectively higher than it would be from a regular GST supplier, as there is no GST refund available. Conclusion: a composition dealer helps simplify the GST process for small businesses by allowing them to pay a fixed tax rate. However, for buyers purchasing goods from composition dealers, no GST is charged and input tax credit cannot be claimed. This system reduces compliance burdens but limits certain tax benefits. I hope you understand easily each question. All the best students for your upcoming exam. For other subject quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.